if you have high income, whatever excess capital you have, you don't want to leave it in the bank because obviously inflation is going to eat away at your money. So you want to find something to counter that. And usually if you have tangible assets like real estate, they're usually the safest. And you'll notice, like, even when the markets drop, what's going on, everyone? I wanted to kind of cover a very important topic today in regards to real estate investing versus active income strategies, because it seems like the two have kind of morphed into one another. So I'm seeing a lot of people associate real estate investing with fast and easy, quick profits, just because that's kind of been the trend in a rising economy. We've been seeing people making like hundreds of thousands of dollars in a matter of a year, 2 years, etc. So people would just put a down payment into anything, whether it's finished, unfinished, pre-construction, resale, commercial, and almost always you could guarantee a minimum of like 7 to 10% yearly rise. And that's not really normal. And recently we saw like almost 20% year over year appreciation. So there's people that were able to really profit off that. And, you know, I'm not gonna lie, like I benefited off of that too, but it's not really how investments work, and there's a reason why it hasn't lasted that long. Because as soon as it got really crazy, that's where we saw the massive drops, and a lot of people lost a lot of money along the way. So that concept of investing is very flawed, because generally speaking, if you think about it, investment is more so like a security-driven play where you're taking excess capital that you're generating through whatever means. So if you have high income, whatever excess capital you have, you don't want to leave it in the bank because obviously inflation is going to eat away at your money. So you want to find something to counter that. And usually if you have tangible assets like real estate, they're usually the safest. And you'll notice, like, even when the markets drop, they're not as volatile as like stocks or crypto because they're not liquid, right? You need to go through a whole process to sell them off. So it's not as easy to just move them and sell-offs happening. So that's kind of why people got into real estate investing. That's the fundamental basics. And I think it's always good to return to the basics because a lot of things don't change even with time, right? Like with real estate, if you think about it, like right now, the average house price in a lot of areas is almost like 8 to 10 times the average income, which doesn't add up. And like, if you look back even like 10 years ago, it was only 3 times the average income. So those two things need to be lined up, and they need to be in parallel, because otherwise there's going to be extreme unaffordability and there's going to be supply and demand issues like we have right now. So I would say, like, it's not like you can't build wealth through investing, because fundamentally, like, if you're looking at it, when you are investing in a property, generally you have 3 things, right? You're doing mortgage pay down, you're getting cash flow, and then the third one is not actually supposed to be guaranteed. It just depends on a lot of other factors, but appreciation, right? Appreciation obviously in a way is guaranteed, but not like the numbers we've been seeing. Usually just due to inflation, asset prices rise as well. And over time, like through the mortgage pay down, you build up enough equity where, you know, after like 10, 20 years, you could have like a close to paid off house. So that's how things generally work. Obviously there's times where there's other economic factors that'll contribute to asset prices rising, but when it happens too quickly and, you know, it's becoming too easy and too good to be true, it usually is. And that's what we're seeing now, where prices are coming down like 20, 25%, and affordability is just like out of question. It doesn't even make sense. So I would say, like, you have to kind of just continue with the fundamentals. And if you're not like already invested, you don't have any property, I would say if you are looking at getting in, or if you're buying like additional assets, I would say just like go back to the basics and look at it at fundamentals. You don't want to have high expectations or high hopes for like quick turnaround or try to buy multiple properties. Like right now, that was easier before. When rates were low, it's easier to qualify. The market was more stimulated. There's more money flowing in the market. But right now, it's time to kind of be a little bit more cautious, as you should be in general with investment. It's kind of just a core attribute, I would say, of like real estate investing anyway. I'm not gonna say like there's no way to make active income. Like there's 100% like active income strategies within real estate. So you could get into things like flipping, short-term rentals, etc. But the issue is those are actually active businesses. So if you compare the two, one is just a security-driven, informed decision where you're investing money into something. The other one is like a tactical business strategy, right? That you're working on every day. It's where your income is coming from. So you can't like mix the two. Like you can, but then you're getting into things like flipping, and those are a lot more dangerous as well. Like if you're actually running, for example, like a flipping business, you're gonna have to make like very specific types of decisions. You're gonna have a lot of, I would say, like there's a lot more that goes into flipping, right? Like from even the type of deals you're picking up, you're almost always gonna have to buy under market value. You have to assess all your costs, the moving parts, and it's very transactional. And then on the investment side, you can afford to make mistakes because you're gonna be holding on to a property for a long period of time. So over time, like things will fix themselves, like even if you went over your budget on renovations, etc. But active income strategies, they're less forgiving, right? Especially in times like this. And a lot of people were making easy money even in those active income strategies because there was so much demand. Like for flips, for example, even if you went over budget, a lot of people would be fine because if they're reselling in 3 months, property values have gone up 5%, and whatever they lost, they made back. And same with short-term rentals. There was so much demand because there was travel, people were spending more money, and now that's calmed down as well. So now you really have to be tactical. You have to be good at what you're doing. So if you're in an active income strategy, which is a business, you actually have to be good at doing that. You have to be very strategic. You have to have a solid plan. You have to stand out. And if you can't do that, then you're going to lose money. And we're seeing that happening as well, like with short-term rentals that are mediocre. You know, they're not really getting as much attention. They're not getting booked as much. Flips that are like not up to par with other properties in the area, they're gonna often get the same amount that like a mediocre property will get. People are not gonna overpay you just because you did minimal work. So you really have to stand out, and you really have to do your research and follow trends and stay on top of things. Basically, all this is to say, like, you have to learn to differentiate between the two, because if you're someone who's working like a regular job or whatever it is, like you have even another business, don't think of this like as another like annual income that you're gonna have where, you know, you're just gonna buy a property for investment purposes and hopefully the values will go up like every 2 years by 20%, you're just gonna sell it. Like, that's probably not gonna happen right now, at least for the next couple of years, unless something really changes, which it would be nice, but it's unlikely. It just wouldn't make sense. It's not good economically speaking, right? I would say like think of it more so from like a fundamental perspective, where if you do have excess capital, just make an informed decision and connect with people local to the market you're looking in, because right now those things do matter, like the small details. So if you're looking in the Hamilton, Ontario market, just reach out to me. I'll leave my contact info below, and I'll leave the Hamilton investment guide down below as well, and you can download it. And yeah, just reach out to me if you have any questions.